Hello and welcome to another stock analysis video on my investment YouTube channel. As some of you may recently seen, I've passed 130 subscribers on YouTube. I really appreciate everyone who's subscribed so far, and if you haven't subscribed yet, please do to ensure you don't miss any future stock analysis videos, portfolio updates or general market news. I'm trying to hit 200 by the end of the month and I'm pretty sure that's doable, so make sure you subscribe. Now let's get into what this video is really about. I'm sure you've all seen the thumbnail and the title and seen we're analysing a high potential growth pharmaceutical company today called AcelRX Pharma. Many of my regular viewers know the format by now, so before getting into any analysis of the actual stock, we must first understand the company, what they do and how they earn their money. Now they're a small cap company with a market cap of just $262 million. They're based out of Redwood City, California, which is in the Bay Area, and since being founded in 2005, they focus on developing and commercialization of therapies for the treatment of acute pain. Their main product is Disuvia, or Disuvio in Europe. They've recently been approved for their use. Currently in the US, Disuvio is approved for use in medically supervised healthcare settings, such as hospitals, surgical centres and emergency departments, according to their website. Vince Angotti is the current chief executive officer for the company and has confirmed that the US military has ordered Disuvio back in 2017. An old article now announced that AcelRX had received funding from the US Department of Defense to develop the drug, and this is huge as they are the world's largest employer with 3.2 million employees on the payroll. And also, as we know, the military has become a client which is guaranteed revenue for the company. They have also recently announced that they have become an approved vendor for one of the largest ambulatory surgical centre networks in the United States. And what this means is that physicians can now use Disuvia at more than 300 locations around the country. And there was some backlash, however, as Disuvia is an opioid, which makes it instantly frowned upon by many due to the ongoing addiction crisis that is facing much of the United States currently. But the fact that it made it through the FDA approval process in what is the tightest regulatory period for opioids in history is fantastic news for the safety of their drug. They have recently announced earnings report. On the 8th of May, they announced a quarterly loss of 17 cents per share versus an expected loss of 23 cents per share. And neither of these numbers are fantastic, but something to consider is that they've recently gone through the extremely costly process of developing a brand new drug and then bringing it to market through many approval phases and tests. And it's normal for them to be reporting losses currently, especially as the earnings report only takes into account for Disuvia being on sale for 5 weeks and only approved in 5 hospitals at the time of the earnings report. They did, however, note that they were approved in all meetings with hospitals that they had, and they have 41 meetings set by the middle of the year. Despite spill-making losses, the earnings report did represent a 26% earnings surprise, which is the second time they've beat earnings per share in the last 4 quarters. Revenue, however, is where the company did not perform so well. With revenue at just $260,000 for the quarter, ending May 2019, this missed estimates by a massive 68.64%. And this took the share price down a massive 10% the day after earnings. So now it's time to review some of the actual numbers behind the company. And now because they aren't currently making a profit, we're unable to use common metrics like the price to earnings ratio. That doesn't mean that we can't have a look at future earnings forecasts to learn how long until the profit is expected, their debt levels and much more. Let's first take a look at their earnings and their revenue growth estimates. The first thing you'll notice here is the 70% annual growth in earnings. And this is predicted from an average of 8 analysts at simplywallstreet.com, which is where these figures and graphs came from. That is extraordinary growth on the surface of it, but when you consider the position they're in with the release of a new drug that they predict there is an over $1 billion market for, and their current earnings are at negative 17 cents per share, this is plausible, and I can see why the analysts came to this conclusion. Something else interesting worth pointing out is that they're not expected to post positive earnings until the middle of 2022, and that's 3 years without positive earnings, and this can be concerning in the fact that does the business have the necessary cash to support this? The statistics seem to indicate that they can, as they have sufficient cash runway for more than 3 years based on the current free cash flow. That is assuming, however, that their free cash flow continues to grow at a rate of 17.5% per year. Now for the part that was always going to be rough for a company like AcelRX with high costs and low revenue, the debt to equity ratio. The graph on the screen does not make for nice viewing. However, the company ended the quarter of 2019 with $90 million and $200,000 in cash and short-term investments and $10 million in senior debt. It cost them $2.3 million to service this debt as it's currently amortizing. They do have, however, $102 million in other liabilities. This can be defined as minor liabilities such as small accounts payable and liabilities that do not incur interest and are paid over a period longer than 1 year. Now this is quite strange to have 10 times the current liabilities to current debt, especially for a company that is not part of a holding company that does not do intercompany borrowing, as this is frequently the place accountants declare that. So although the debt level is justified, I would remain cautious if you are investing, especially with the analysts expecting the company not to make a profit until 2022. Another interesting metric to look at is the trades taking place within the company. This can give a fantastic idea of the general consensus of staff and what they feel about the value of the stock, as if they're buying it is likely an indication that the staff believe the product and the company is currently trading at a fair value. Looking through the records of insider trading made by ACRX, they are all purchases, as you can see. Not all massive quantities, but just the fact that purchases are being made rather than them removing equity is a good sign, and it bodes well for the future of the company that the staff believe in something they're working for. The next thing I want to get into is the predictions of analysts and where they forecast the stock price is going to be. Now, it's hard to predict ACRX, and them themselves have said that it will be the third and fourth quarters of 2019 where we really get an indication of the effects of Vesuvia on their revenue. But it can be an interesting thing to review anyway. So this is from CNN Money. They have 7 analysts covering the stock, and over 12 months forecast, they believe a median estimate of $8, a high estimate of $10, and a low of $6. This is optimistic in my opinion, but if they are able to demonstrate strong demand for Vesuvia, then it could be possible. The median estimate would be a 153% increase over the current price. And it now makes sense why this stock is determined high potential growth, but high reward is usually accompanied by high risk, and I believe this stock could be set up for failure if they are unable to get Vesuvia to the market in the way forecasted, so operate with caution if you were to buy this stock. So, I hope this short video gave you an overview of a stock you may or may not have heard of. Now, always do your own research if you're planning to buy. This stock interested me because I enjoy small caps of high potential, and if that interests you too, it may be worth looking at more closely. However, as I said before, I class this as a high risk stock, so be careful with the amount you invest into a company like this. Thank you so much for watching, I really appreciate it, and if you learned anything, make sure you're subscribed if you haven't already. And if you have any comments about the stocks or anything I've missed at all, please comment down below so everyone can see. Like the video if you enjoyed it, and I hope to see you in the next video. Thank you very much for watching.